Welcome to History Explained, where we illuminate the past to better understand our present. I'm your guide to your daily journey through the past to empower the future. Today is Friday, May 23, 2025. As we do every Friday, we're exploring a significant economic milestone that shaped the development of our modern financial system. Today, we turn our attention to the creation of the Federal Reserve System in 1913, a watershed moment in American financial history that fundamentally transformed how the United States managed its monetary policy and banking system. Often simply called the Fed, this central banking system emerged from a complex mix of financial crises, political maneuvering, and competing economic visions for America's future. What makes the Federal Reserve's creation particularly fascinating is how it represented a delicate compromise between different interests: bankers seeking stability, progressives demanding reform, and a public deeply suspicious of concentrated financial power. The Fed's establishment marked a pivotal transition in America's approach to banking and continues to influence every aspect of our economic life today. So let's explore the tumultuous path to the Federal Reserve's creation, examining the financial crises that spurred reform, the key figures who shaped the institution, and how this central banking system has evolved to become one of the most powerful economic entities in the world. To understand why the Federal Reserve was created, we must first examine the volatile financial landscape that preceded it. The United States in the late 19th and early 20th centuries experienced remarkable economic growth but also suffered devastating financial panics with alarming regularity. Major banking crises erupted in 1873, 1884, 1890, 1893, and 1907, each causing widespread bank failures, business bankruptcies, and economic hardship. Unlike most developed nations at the time, the United States lacked a central bank to provide stability during these crises. The First Bank of the United States, 1791-1811, and the Second Bank of the United States, 1816-1836, had previously served some central banking functions, but both institutions were allowed to expire amid fierce political opposition, particularly from those who feared concentrated financial power. The absence of a central bank left America with a fragmented, decentralized banking system that had serious structural weaknesses. Banks issued their own currency backed by their gold reserves, leading to a bewildering array of bank notes of varying reliability. Interstate banking was restricted, creating thousands of small, undiversified local banks vulnerable to regional economic downturns. Perhaps most critically, the system lacked an elastic currency that could expand or contract with seasonal and cyclical economic needs. These weaknesses came to a head during the Panic of 1907, a financial crisis that would ultimately serve as the catalyst for the Federal Reserve's creation. The panic began when a failed attempt to corner the market in United Copper Company stock triggered a run on associated banks. The crisis quickly spread throughout the financial system, with banks and trust companies failing across the country. What made the Panic of 1907 particularly significant was the absence of a governmental mechanism to stem the crisis. Instead, stability was restored largely through the efforts of private banker J.P. Morgan, who organized a coalition of financiers to provide liquidity to the market. While Morgan's intervention eventually halted the panic, The experience underscored the system's vulnerability and the problematic reliance on a private individual, no matter how capable, to perform what many viewed as an essential public function. The aftermath of the 1907 panic created the political momentum for banking reform. President Theodore Roosevelt's administration had already been pursuing a progressive agenda of regulating business and curbing the power of trusts or monopolies. The panic strengthened the hand of those arguing that the banking system required similar oversight. In 1908, Congress passed the Aldrich-Vreeland Act, which created emergency currency provisions to prevent future liquidity crises and established the National Monetary Commission to study banking systems worldwide and recommend reforms. This commission was headed by Senator Nelson Aldrich of Rhode Island, a prominent Republican with close ties to the banking industry. The commission spent nearly 2 years studying central banking systems in Europe and consulting with financial experts. This research culminated in the Aldrich Plan of 1910, which proposed a National Reserve Association, a central bank controlled primarily by private bankers rather than the government. The plan was developed during a famous secret meeting at Jekyll Island, Georgia, where Aldrich met with representatives from the nation's most powerful financial institutions, including bankers from J.P. Morgan and Company and Kuhn, Loeb and Company. The Aldrich Plan faced immediate political challenges. Democrats and progressive Republicans viewed it as giving too much power to the money trust, the Wall Street bankers who already dominated American finance. With the election of Democratic President Woodrow Wilson in 1912 and Democratic majorities in Congress, the Aldrich Plan in its original form was effectively dead. However, Wilson and leading Democrats recognized the need for banking reform. Rather than rejecting centralized banking entirely, they sought to create a system that would provide financial stability while ensuring public oversight and decentralizing power away from Wall Street. The task of developing a democratic alternative fell primarily to Congressman Carter Glass of Virginia and H. Parker Willis, a banking expert. Their plan maintained the concept of a central banking system but modified it significantly to address progressive concerns. Instead of a single central bank, they proposed a regional system of reserve banks that would be responsive to local economic needs while still coordinated at the national level. President Wilson made two critical contributions to the plan. First, he insisted on the creation of a Federal Reserve Board appointed by the President to provide government oversight of the system. Second, he supported the addition of provisions giving the Federal Reserve control over the discount rate, the interest rate at which it lent to member banks, providing crucial influence over monetary policy. The resulting Federal Reserve Act represented a carefully crafted compromise between different visions of reform. It created 12 regional Federal Reserve banks, each owned by its member banks but operating under the supervision of the Federal Reserve Board in Washington, D.C. This structure balanced centralization with regional autonomy, public oversight with private participation. After intense debate and numerous amendments, the Federal Reserve Act passed Congress in December 1913 and was signed into law by President Wilson on December 23, 1913. Wilson praised it as a "constitution of peace" for the business world and the first of a series of constructive acts to improve America's economic system. The Federal Reserve System officially began operations on November 16, 1914, just as World War I was engulfing Europe. The timing proved fortunate, as the new institution helped manage the economic challenges created by the war and positioned the United States to emerge as a global financial power. The original Federal Reserve System differed in important ways from the institution we know today. Its initial mandate was narrower, focused primarily on providing an elastic currency, serving as a lender of last resort to prevent bank panics, and improving the supervision of banking. The broader goals of maintaining price stability and maximizing employment that define the modern Fed's dual mandate evolved later. The early Fed also had more limited tools at its disposal. The primary mechanism for influencing the money supply was the discount window, through which the regional reserve banks could lend to member banks. The Federal Open Market Committee, which today conducts monetary policy through open market operations, buying and selling government securities, wasn't created until 1933. The Federal Reserve faced its first major test with America's entry into World War I in 1917. The Fed supported the war effort by maintaining low interest rates to help finance government borrowing and by promoting the sale of war bonds. While these policies helped fund the war, they also contributed to significant inflation, with consumer prices rising approximately 82% between 1917 and 1920. Following the war, the Fed shifted to a contractionary policy to combat inflation, raising interest rates significantly in 1920. This contributed to a sharp but relatively brief recession in 1920–1921. While painful, the recession did succeed in reducing inflation, and the economy soon returned to growth. This episode demonstrated both the Fed's growing influence over the economy and the challenges of balancing competing priorities. The greatest failure of the early Federal Reserve came with the onset of the Great Depression. When the stock market crashed in 1929, the Fed's response was inadequate to prevent the subsequent banking crises and economic contraction. Between 1930 and 1933, a series of banking panics led to the failure of thousands of banks. Many economists, most notably Milton Friedman and Anna Schwartz in their influential work, A Monetary History of the United States, have argued that the Fed actually worsened the Depression by allowing the money supply to contract dramatically when it should have been expanding it. The Fed's reluctance to act aggressively as a lender of last resort represented a fundamental failure to fulfill one of its core purposes. The Fed's ineffectiveness during the Depression led to significant reforms in the 1930s that substantially reshaped the institution. The Banking Acts of 1933 and 1935 centralized power within the Federal Reserve System, strengthening the Board of Governors in Washington at the expense of the regional reserve banks. The 1935 Act created the modern structure of the Federal Open Market Committee and expanded the Fed's tools for conducting monetary policy. Another crucial development was the 1951 Treasury-Fed Accord, which freed the Federal Reserve from its obligation to support government bond prices. During World War II, the Fed had committed to maintaining low interest rates to help finance the war effort, effectively subordinating monetary policy to the Treasury's financing needs. The 1951 Accord re-established the Fed's independence to pursue monetary policy based on economic conditions rather than government financing requirements. The post-war era saw the Federal Reserve gradually embrace more activist management of the economy. Under the chairmanship of William McChesney Martin Jr., 1951-1970, the Fed developed its approach of leaning against the wind, tightening monetary policy during economic expansions to prevent inflation and easing during downturns to stimulate growth. The 1970s brought new challenges as the U.S. experienced stagflation, the combination of high inflation and economic stagnation. Under Chairman Arthur Burns, the Fed's policies were often influenced by political pressure from the Nixon administration, contributing to inflation that reached double digits by the end of the decade. A dramatic shift came with the appointment of Paul Volcker as chairman in 1979. Volcker implemented a monetarist approach, focusing on controlling the growth of the money supply rather than targeting interest rates directly. This led to extremely high interest rates. The federal funds rate peaked above 20% in 1981 and triggered a severe recession. However, Volcker's policies successfully broke the back of inflation, establishing price stability as a paramount objective of the Fed and reinforcing its independence from political pressure. Under Alan Greenspan, 1987-2006, the Federal Reserve continued to prioritize price stability while placing greater emphasis on financial market conditions. Greenspan's tenure saw extended periods of economic growth with low inflation, contributing to his reputation as a masterful economic manager. However, critics later argued that Greenspan's reluctance to rein in asset bubbles and his light regulatory touch contributed to the conditions that led to the 2008 financial crisis. The 2008 crisis and the Great Recession that followed pushed the Federal Reserve into uncharted territory. Under Chairman Ben Bernanke, an expert on the Great Depression, the Fed took unprecedented steps to prevent a financial collapse and stimulate economic recovery. With conventional interest rate policy constrained by the zero lower bound, rates could not go below zero, the Fed turned to unconventional tools like quantitative easing, the large-scale purchase of financial assets to inject money into the economy. These unconventional policies continued under Janet Yellen and, to some extent, Jerome Powell, as the Fed navigated the challenges of a slow recovery, persistently low inflation, and later, the economic shock of the COVID-19 pandemic. The Fed's balance sheet expanded dramatically, from under $1 trillion before the 2008 crisis to over $8 trillion by 2021, reflecting its increasingly active role in managing economic challenges. Today's Federal Reserve has evolved far beyond what its founders envisioned in 1913. Its mandate has expanded to include maximizing employment, stabilizing prices, and moderating long-term interest rates. Its toolkit has grown to include a vast array of conventional and unconventional policy instruments. And its influence extends beyond national borders, with Fed decisions sending ripples throughout the global financial system. The Fed's evolution reflects broader changes in economic understanding and the increasing complexity of the financial system. From the classical gold standard that prevailed when the Fed was founded to today's fiat currency system, from the relatively simple banking system of 1913 to today's complex global financial markets, the Fed has continually adapted to changing circumstances and challenges. Despite its evolution, the Federal Reserve continues to embody the fundamental compromise at the heart of its founding, balancing public oversight with private participation, centralized coordination with regional responsiveness, and political accountability with operational independence. These tensions are not bugs in the system but features that reflect the diverse interests the Fed must serve and the competing priorities it must balance. The Federal Reserve's creation marked a pivotal shift in America's approach to banking and finance. Before the Fed, the United States had a fragmented, crisis-prone financial system that frequently experienced devastating panics and depressions. After its establishment, financial crises became less frequent and severe, though certainly not eliminated, as the 2008 crisis demonstrated. Beyond its direct role in stabilizing the financial system, the Federal Reserve has contributed to fundamental changes in how we understand and manage the economy. The idea that a central bank could and should actively manage the money supply to promote economic stability represented a significant departure from earlier economic thinking. The Fed's evolving approach to monetary policy has both reflected and shaped developments in economic theory. The Fed's history also illustrates the ongoing tension in American society between centralization and decentralization, between government intervention and market forces, and between technocratic expertise and democratic accountability. These tensions have shaped the Fed's structure and policies from its inception to the present day. As we look to the future, the Federal Reserve faces new challenges and questions. How will it navigate the unwinding of the extraordinary measures taken during recent crises? How should it respond to emerging financial innovations like cryptocurrencies and decentralized finance? How can it balance its multiple objectives in an increasingly complex and interconnected global economy? What seems certain is that the Federal Reserve will continue to evolve, as it has throughout its history, adapting to new economic realities while maintaining its core purpose of providing financial stability and promoting economic prosperity. The institution born of the financial crises of the early 20th century remains a vital component of our economic system, its decisions affecting every aspect of our financial lives. Thank you for joining us for this exploration of the Federal Reserve's creation and evolution. Next week, we'll be back with our Military History episode where we'll be examining the Battle of Midway and its decisive role in the Pacific theater of World War II. If you enjoyed this journey through history, please like this video, subscribe to our channel, and hit the notification bell so you never miss an episode. We'd also love to hear your thoughts. What aspects of central banking history or economic policy do you find most interesting? Let us know in the comments section below. For our members, this Sunday we'll have a special roundup of economic developments from the past week with additional historical context and analysis. We'll explore how current financial events connect to the longer history of economic institutions and policies we've been examining in this series. Until next time, I'm your guide for History Explained, where we believe that understanding yesterday is the key to navigating tomorrow.